Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're taking a magnifying glass to a specific microcap company that's been lighting up our hard-to-borrow screener, GITS. We'll break down exactly what makes GITS stand out and what these unique conditions could mean. Stick around, because understanding these mechanics can be a game changer for your market knowledge. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/symbol for GITS. Let's talk about GITS, a microcap company that recently appeared on our radar due to some extreme metrics in the borrow market. In terms of recent price action, GITS has seen a 0.0% change today, a 0.0% change over the last 5 days, and a 0.0% change over the last 30 days. Similarly, the trading volume for GITS today was 0 shares, with a 30-day average volume also at 0 shares. This means GITS is currently an extremely liquid stock showing virtually no trading activity. This lack of activity might seem counterintuitive for a squeeze candidate, but it means that if volume were to pick up, the underlying borrow conditions could become highly amplified. What is cost to borrow and why it matters? So, what exactly does it mean when a stock is hard to borrow? When a short seller wants to bet against a company like GITS, they first need to borrow shares. Just like borrowing money, there's a fee involved. We call this a cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. The higher the CTB, the more expensive it is for short sellers to maintain their positions. Think of it as interest you pay on a loan. If the CTB goes through the roof, it becomes very costly to stay short. This can force short sellers to rethink their strategy, especially if the stock price starts moving against them. These fees can often exceed 100% annually, meaning short sellers could pay more than the entire value of their borrowed shares in fees over a year, just to hold the position. Why the stock is hard to borrow right now. Now, let's look at the specific numbers for GITS that got our attention. The annualized cost to borrow fee for GITS is an astonishing 932.3%. Yes, you heard that right, over 900%. This is an incredibly high fee, indicating extreme demand to borrow shares and very limited supply. While the CTB momentum has seen a slight dip, easing by 21 percentage points over the last 5 trading days, the overall level of 932.3% remains extraordinarily high. Highlight 932.3%. Adding to this scarcity, there are only 2,000 shares of GITS currently available to borrow against an estimated float of 2.4 million shares. That's a tiny fraction of the total shares in circulation. Our internal composite squeeze score, which combines factors like CTB level, momentum, borrow supply, float size, and technicals, currently gives GITS a score of 42.7 out of 100. This score indicates a noteworthy, albeit not yet critical, setup given the current lack of trading volume. Squeeze mechanics explained. So, how does this all tie into a potential short squeeze? Imagine you're a short seller betting against GITS. You've borrowed shares and sold them, hoping to buy them back cheaper later. But suddenly, the stock price starts to rise. At the same time, your lenders who might need their shares back, perhaps because they want to sell them at the new higher price, issue a share recall. Now you, the short seller, are in a tight spot. You must buy back those shares to return them, regardless of the price. If many short sellers are in this same predicament, and there are very few shares available, like only 2,000 for GITS, their frantic buying creates a snowball effect, pushing the price even higher. This forced buying by short sellers to cover their positions is the core mechanic of a short squeeze. High CTB fees accelerate this process, as short sellers face increasing daily costs, pressuring them to cover before those fees eat away their entire potential profit, or even their capital. Dilution risk check. An important factor to consider in any potential squeeze setup is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can effectively offset or completely negate a short squeeze thesis, even if the cost to borrow is sky high, because it floods the market with new supply that short sellers can use to cover their positions. For GITS, we've checked recent SEC filings and found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also haven't found any recent reverse splits for GITS in our look-back window. This is a positive sign, as it means there aren't immediate, known catalysts for new shares to flood the market and undermine a potential squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with GITS? Despite the incredibly high 932.3% cost to borrow and the extremely limited 2,000 shares available to borrow against a 2.4 million share float, GITS has had zero volume and zero price change recently. This indicates extreme liquidity. A high cost to borrow does not guarantee a squeeze. It can also mean short sellers have incredibly strong conviction and are willing to pay those exorbitant fees to stay short, believing the stock will eventually fall. However, if GITS were to experience a sudden surge in trading volume and sustained upward price movement, those high CTB fees and the scarcity of shares could become incredibly significant. A sudden influx of buyers could quickly overwhelm the limited supply of shares, forcing short sellers into a difficult position. Monitor for any changes in volume or price, as these would be the initial triggers. GITS presents a fascinating case study in the hard-to-borrow universe. With an astronomical 932.3% cost to borrow and a mere 2,000 shares available to borrow, the underlying conditions for a squeeze are technically present, but the current lack of volume means this potential remains dormant for now. It's a prime example of how extreme barometrics coupled with liquidity can set the stage for something dramatic if market interest ever picks up. Remember, always do your own thorough research. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth stock analysis, and let us know in the comments what other stocks you'd like us to investigate. Thanks for watching, and we'll see you in the next video.